let's explore this acquisition situation. The following book and fair values were available for the Lying President Corporation as of March 1st. And you see the information in the table. Now, underneath the table, it says the Truth Company pays $4,060,000 cash and issues 29,600 shares of its $2 par value common stock. The fair value is $50 per share for all of Lying President Corporation's common stock in a merger after which the Lying President Corporation will cease to exist as a separate entity. Stock issue costs amount to $31,200, and the Truth Company pays $49,000 for legal fees to complete the transaction. Okay, and what we need to do is record this acquisition on the books of the Truth Company. There are a couple entries we need to make. The first one is to put the assets and the liabilities of Lying President on our books, and we do that at the fair value. So in any instance where we knew or we determined fair value, we record that. So you see inventory, land, buildings, and customer relationships were put on the books at $859,000. Now, $859,500 was for customer relationships, and you can see I'm using the fair value to record the other assets as well. The fair value of accounts payable was equal to its book value, so we record that as a credit, increasing accounts payable, so that essentially we're assuming the liabilities of the Lying President Corporation. And then what we have to do is show the compensation for this acquisition. So we issued 29,600 shares of stock. It had a $2 par value. So if we take 29,600 times 2, we get 59,200. You can see that just to the left of my mouse there. And then they also said we paid $4,060 cash plus the common stock. So there's the cash that gets recorded. Now, how did we come up with the additional paid-in capital? Well, we took the $50 fair value less the legal capital, which is the common stock. And if we subtract that portion out, the total of that comes out to be the $50 share price times 29,600. That's how we came up with the total value. Subtracting the 59,200, you get 14,2800. Okay, now let me show you the math involved with that $1,420,000 of additional paid-in capital. I'm just using this little calculator that I use because it lets me add some nice commentary to the side. So there's the logic, right? 29,600 shares times $50 was the fair value price. So we know the fair value of the stock issued in this transaction was $1,480,000. And then we subtract out the par value. I should probably add that in, right? Par value of common stock that we already recorded. And so the difference is the $1,428,000 of additional paid-in capital. Okay? Okay, so once we put the $1,428,000 and the common stock and everything else at its fair market value, our debits won't equal the credits. Now, what that means is we either paid more for the fair value of the assets, in which case we need to record goodwill to make the account balance, or we had a bargain purchase. And in this case, we paid more for the fair value of the assets than, well, let me say that another way. I guess I was saying that correctly. We paid more for the fair value of the identifiable assets we could identify. I know I'm a little bit of double talk here. Bear with me. Now, when we paid more for the identifiable fair assets than what we paid in compensation, the difference is goodwill. And you could put a schedule together to calculate that, but you could also just put the journal entry together and you'll see that goodwill will just fall out. It has to, because that's what it represents. And we have two other entries to record. They said in the information provided that stock issue cost amounted to $31,200 and they paid $49,000 for legal fees. Well, legal fees are not to be included in the net assets of what we acquire, so we record that as an expense when it's incurred, and there you see the $49,000 of professional services recorded. And a company could call it professional service expense. They could call it legal fees. Every company can call it whatever makes sense. And then they also said the stock issue cost amounted to $31,200. Well, if we had stock issue cost, that comes out of additional paid-in capital. So we reduce additional paid-in capital for the $31,200 and we credit cash. Now, in this example, these entries were made in 3 separate transactions. You could have combined them all in one, right? You could have netted the cash and netted the additional paid-in capital, but I think it makes more logical sense to record the acquisition at fair value and recognize goodwill, and then after we do that, show expenses that are paid and any stock issuance costs that are paid. The other reason I think it makes sense to prepare it this way is the organization is probably using some kind of accounting software, and accounting software tends to break items down into separate transactions rather than combining them in one massive general journal entry. Okay, so I also think breaking these down in separate transactions is a better representation of how the transactions would be recorded in a real general ledger when accounting software is being used.